my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investors International Limited. And here is your daily technical analysis of foreign exchange markets. We're going to start with the euro against the dollar. So, target X at 118.05 has been achieved yesterday, and then some, with a third bearish black crow. The market dropped down well into the congestion from August to November last year, all the way down to halt at the 50% Fibonacci line at 117.58 from the big June 2020 to January 2021 move. Overhead, we now have the significant June 2018 high at 118.51, the middle time of the 2021 bearish Andrews pitchfork currently at 118.52, and the rising long moving average currently 118.73. Looking below the 50% Fibonacci line at 117.58, we obviously have provisional targets X1 at 117.05 and X2 at 116.15 as an initial and final target for the idea that the last 3-4 weeks had been a possible bear flag in formation. Separately to that, we have the old neckline from the August to September 2020 continuation head and shoulders pattern currently at 117.18. Though I'm not sure how good that will be. A lesser Fibonacci line also at 116.94 and the recent lows from September November 2020 at 116.11 and 116.02. One final point, and it is a long-term one, slipping into from below is the continuation lower diamond trend line from the December 2019 to May 2020 super diamond pattern currently at 116.02. It's worth considering this as the upper trend line halted the rise back in July, August, September, December last year and January this year. So far today, a reactionary pullback up, unsurprising I suppose for a Friday to see some position squaring, might possibly, if it continues, be a bullish piercing line pattern or bullish thrusting pattern at an outside. But it depends, there's a lot still can go on between now and the close today. Cable, aka sterling against the US dollar. A bullish harami yesterday as the market reacted to moving just that little bit too close to the rising medium moving average below, currently at 136.33, while still being within the congestion zone, 136.5 to 137.5 from January and February this year. Above we have the soon to be flatlining short medium moving average currently at 138.17. and the remnants of the broken November 2020 today uptrend currently at 138.29. Now below the moving average, the medium moving average, we have the supremely important lower time, currently at 135.76 of the late June, late September 2020 bullish shift pitchfork. This lower time, along with the middle time above, which is currently at 140.35, have given the bullish angle of attack of this market since September last year. So far today, a nice looking follow-on higher to yesterday's bullish harami, maneuvering out of the 136.5, 137.5 congestion zone exactly the way a ship in the Suez Canal doesn't. Euro sterling. All still quite tense here, as yesterday saw a significant bearish black Marubozu. The market turned around and drove back down into the descending triangle made up of the recent broken downtrend, currently 85.82, and the flat congestion at 85.45. This move back down means that the whole of this week's earlier move higher, outside the descending triangle, has been a false break. That's something I highlighted may happen. So, looking below, we still have the original 3 targets. Target X2 for the second quarter of 2020's head and shoulders top, that's in the 85.15 area. Target X1 in the 84.75 area. That's the target for the recent sideways triangle. And finally, possibly target X3 in the 84.5 area for the recent descending triangle pattern. I've also left target X4 above the market on my daily chart, the target for a possible break upwards of the descending triangle. That is in the 87.15 area. The reason why, you may ask? Well, if there's one thing I've learned about patterns, especially triangles, is that never underestimate the chances for another false break. So far today, a further dip lower down to the congestion at 85.45, but no more than that at this time. I will raise one possibility though. If we dip further down, below last week's low at 85.30, and then close anywhere near it tonight, then we could have a weekly key reversal down. This is not on at this time, but the door is open. US dollar against the Indian rupee. A third bullish white soldier yesterday, but it was not a new high as the top was capped, much like the previous session, by the middle time, currently 72.67, on the October 2020 to February 2021 bearish Andrews pitchfork. This seems to have been a legitimate try higher that was halted, the market closing between the middle time above and the 50% Fibonacci line, the July 2019 to April 2020 move at 72.64 below. The action nevertheless moves the idea of a recent descending triangle further away and the concept of the recent falling wedge pattern closer. At the moment, we have a preliminary topside target X2 for the falling wedge pattern in the 72.60 area. This would only be good if the break higher is not a false break, which is still questionable. Meanwhile, below we have target X1 on the downside for the same pattern in the 71.25 area, just in case, and the target X at the February 2020 high at 72.05 for the old descending triangle idea. So far today, a stronger reaction from the market to the combination above of the middle time and the 50% Fibonacci line as prices made what looks like right now, well, a possible bearish opening black Maribozo, but it could turn into a hammer pattern, with a dropping down through the September 2019 high at 72.41, but pulling back up to hold up over it. US dollar against the Brazilian real. A third bullish white soldier yesterday, but a more limited one as the market started to test the overhead very recent 50% Fibonacci line at 566.34. This continuing bullish action further offsets what had started to suspiciously look like a recent bear flag pattern. It is definitely looking less so now. Beyond the 50% Fibonacci, I have little until the congestion of 574.60 area and then the late October 2020 high at 580.70. US dollar against the Mexican peso. A combined bearish engulfing pattern and bearish opening black Maribozo yesterday. I've cautioned over the last few days that the market was getting wary of travelling too far higher, as overhead we have the ominous presence of the slowly declining long moving average, currently 21.0354. Yesterday was the result of that wariness. Prices dropped down and were caught by the old combination of the congestion at 20.60.62 area and the very recent 50% Fibonacci line at 20.58.49. So far today, it seems the fall was not just a reactionary move lower from the long moving average, as prices have started to explore beneath the congestion and the 50% Fibonacci line at 20.60.62 and 20.58.49 respectively. This means we now might have to look once again at the combination below of the 2021 uptrend, currently at 20.41.55, and its partner, the short medium moving average, currently at 20.36.92. Though with the market moving back into the nearby congestion, it is not a sure thing. Thank you for listening. The short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.